Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day, all. Ira Epstein of Linn Associates with your agriculture update for this Thursday, and we are now at the 15th of March, 2018, about 3:30 p.m. Central Daylight Time. As you can see, wheat got hit pretty hard today, and what's the reality of it is, even with these low prices we're getting, we're still not competitive on the world market. There's just so much wheat that keeps hurting the market. Yes, you can make the argument in the hard red winter wheat that we've got a drought and it's in the plains and it's really very serious, and I agree. The problem is you still got to sell that wheat abroad, and that's what's hurting these markets. Doesn't mean that a weather market can't lift things for a bit. Corn market. I think that what happened today was there's a seasonal spread where you can buy beans. Some people sell corn, some people sell wheat, and I think that's looking at it. I know that's one of the popular spreads of beans versus wheat right now. So let's take a look at the charts and get a feel. Didn't help that, by the way, I'm going to come back here. Didn't help that the U.S. dollar was this strong today either. We're getting the late day rally in stocks going for the highs, as you can see. On the weekly area chart of closes, we've gone from 947 to 1060 and 3/4, backed off, and for this week we're up 11.5. Again, the Argentine situation is not seeing the relief that people were hoping for. And even though they get some rains there, we're going to be obviously looking at the weekend to see what that weather's going to hold. A lot of talk here that the areas that need it just aren't getting the rain they need. So we've had a bit of a correction and getting a bounce right now. On the daily area chart of beans, you came under the 18-day moving average of closes, and from 1077 you went down to 1039.25, which created a down thrust, and the fact that you're still under the 18-day average of closes puts me with the big downside bias. We'll see that in a moment on the chart. When we look at this chart and we see the correction, we had a break, a rally high, came down, made a lower low today, and came back in the market. What it's created is a pattern of lower highs and certainly lower lows. To break out of that pattern and not create a bull, but to end the bearish pattern, you'd have to take out 1054. That would leave you then with the pattern of lower lows right here, and then a higher high over the 1054. Until that occurs, I would look for the market to have resistance. Where might that come in? Well, one of the areas might be the 18-day average of closes at 1052.5. Admittedly, getting back over 1054 is only a penny and a half from there, penny and 3/4 to be specific, but that's what I see the resistance area at. In terms of Bollinger Bands, you made a stab for it today, got to 1027, missed hitting it by a penny and a half, and off those lows you rallied 15 cents. That's called a rejection. Didn't quite get down there. Also, I'm concerned that even though we have the 18-day average of closes as resistance, you're so oversold that it'll take very little to trigger some buy stops. So I've got my doubts that you're going to see a lot of traders try to sell into that number. Doesn't mean they won't. But if they take out 1054 in an oversold market that starts turning up, you'll scare traders. In the meal market, we still have the pattern of lower highs. And if we look at this low here, we today got to 369.80, which took out this 370 area. We can see that, if I'm correct, right through here, 370.20, and we took that out today. So we still have the lower highs, lower lows, but like the soybean market, we are very oversold, a dangerous situation. If you get back over 380.30, you break the bear pattern. You'd have to close over 382.30 to give it upside bias. But because you made the lower low, even if you did that tomorrow, you wouldn't end up with a pattern of higher lows, higher highs. You can just end up with a lower low and a higher high. I'm not sure where the bears will defend the position given the oversold condition. In the soybean oil market, up today at the expense of the meal, which is settled sideways. Again, you're playing these spreads, and it's called a crush spread. And every time you look at it, you're trying to figure out what to do. Now, if you saw the crush today, it was huge in terms of adding to the soybean oil that's in stock. The market sort of came back off of that news. So 32.18 is the resistance. Like the other parts of the bean complex, you would think it's oversold, but it's not. Any reading over, in my opinion, 30 is not in oversold condition. It's back over that. So it's a neutral position. I would wait to see what the pros do. Now, let me explain. To get back to the 18-day average, you have to take out today's high of 32.15. I don't know where that average is going to come in tonight when they reopen it. It's probably not going to change materially, but that would create a pattern of a higher low and a lower high if you were to take out today's high. Difficult one. In the corn market, while we're getting a correction and lost the embedded reading, you can see that happening right through here. You're still embedded. These are both numbers still over the 80 level. They lost that yesterday, and when that happens, often prices in the 18-day average make a run at each other. They're doing that right now. Whether they'll hit, I can't tell you, but there's the run at each other. You're out of your uptrend as well. You've got a higher high and a lower low. You certainly have upside bias since you're over the 18-day average, but momentum's down. The whole chart changed when you took out the low of 387, and that's where I think you're at, in the middle of no man's land right now. In the wheat market, unless today's high in Chicago wheat is taken out again tomorrow or Monday, I think the bears grabbed control pretty solidly today with this big break. You close near the low of the day. I would expect the pros to be sellers into the 486.5 area, risking back over today's high. Wouldn't be a surprise to me at all, and that's because you're under the 18-day average, the bias is down, and the momentum is down. And again, I'm not saying to do that or not. I'm just explaining how the chart looks. Take out today's high, and you create what we call, at least what I teach, is called a bear trap. And a bear trap unfolds when the high of an outside day down is taken out within 2 sessions. My rule of thumb, and it's all it is, it's not that there's research saying you're going to go back up here or you're not. My rule of thumb is because the 100-day average is down here, the 18 is here, and you get back over that, you could make a run for that upper Bollinger Band. Don't know, but I think the bears are controlling the market right now. In the sugar market, you came in, and if you look at today's range, 1256 low. If we go back to yesterday's low, the low was 1258. And that's why it's so important you look on your charts, because sometimes visually I see that looking higher than that low, but it's not. So we had an outside day down in a market that, if we look at the slow stochastics, both numbers today are under 20. Yesterday, both numbers were under 20, but not the day before. So if the market's going to get a bounce, it'll give you an idea that maybe it's a combination of a trap for the bears, if you take out today's high, and then trying to turn the stochastics just plain back to the upside a little bit. What do I think? Dangerous for the bears, but with an outside day down, at least I know what I would think. You don't want to see today's high taken out. Doesn't mean you're bullish. You may not be bearish anymore. In the coffee, this was a son of a gun little bitty rally 2 days ago. When that occurred, prior to that, you had this neat pattern of lower highs, lower lows, and that's why you have to look at all parts of a chart. You were very oversold. You then got your bounce up, took out that high, started your correction, correcting the market from an oversold condition, came out of that condition again. Both numbers are back over 30, and when that happens, it's like game on. I don't know where you're at because I have a higher high and a lower low. What I know is the upper Bollinger Band and the lower are sort of moving towards each other, and today you fall right apart back into there. No trend, but down into the lower Bollinger Band. Be careful of cocoa. Why am I saying that? I want you to look at yesterday. You had an outside day up with an embedded reading. The first thing I will tell you is what I think I try to say in my videos for you and what I teach. I still view the slow stochastic, when it's embedded, bullish or bearish, is the main element on a chart. When it loses that bullish reading by getting the red line under 80, then I look for a price in the 18-day average to make a run at each other. In this case, you're still embedded, but today you took out the low of an outside day up. Unless you get over this high right away, you could see this start turning down. And if it does, be careful here. Right now, in my theory on it is you've sprung a bull trap, and I wouldn't be surprised to see price and the 18-day average come together. It is certainly a warning sign for those that are bullish in the market, but I'm going to repeat what I just said. Your hardest thing is figuring out in your own strategy, which do you follow? Do you follow that warning sign or stay with the slow stochastic? In the cotton is having a very hard time getting back under the red line, the 18-day average of closes. You have corrected, past tense, an overbought condition, gotten down into pretty neutral territory. Get under 82.04. You'd be under the 18-day average of 82.49 with a pattern of lower highs and then lower lows. That will get probably the bears excited. Don't get there and take out 83.87, the bulls might say, okay, look, we've kept this pattern. We've now gotten to the point in the market where we can sit back, the mini correction's over, maybe the market's going to resume up again. In other words, tomorrow's an important day. In the cattle market, similar to that coffee trade, you rallied just enough to get up to that 18-day average in 100, failed, but broke the pattern. You're also still in a very oversold condition. You have an embedded reading. It's very different in the April feeder cattle, so the bears have control with what? The embedded reading, which again is my strongest technical indicator. The swing line is not trending. You got a higher high and a lower low out of it, and you're making a run right now for the lower Bollinger Band. In the hog market, similar again to the coffee. You had this pattern, but you had a warning sign at least here. You had a market making lower highs, lower lows. Now, you made this low here. You came right on up. Now, if we look at that low, the low of that day was 66.52.5. And right here, it was 66.42. So the one thing I knew was I didn't want to see this market start getting up and over that in any manner from here. If it did and took out that day's high, it's a warning sign in a market that is oversold. Again, you got to pay attention to all the signs. And that's just what happened, and then it fell right back. So the overall part of the market, bearish since you're under the 18-day average of closes. If you like these explanations, you should try my charting course. It teaches this in a way that it's videos. And we're talking about 6 hours worth of videos. And in those hours, I walk you through in a way where first I'll do a PowerPoint presentation, then real charts for you. You can either call us about it and go to our website under www.iraepstein.com. Go under the word education. I've got a small video that tells you how it works. And we have an FAQ page, a facts page, that explains to you any questions we think the ones we get asked the most time, so you understand the course. It's very inexpensive. It includes charting software, the research, and my all-important morning video where you don't see on YouTube, where I'm actually reinforcing everything you learn every day. Have yourself a good one. And by the way, it's every trading day. I'm Ira Epstein. Take care.